Business and healthcare news headlines are saturated with this sad news. RiteAid is closing its stores. The once premier pharmacy store chain has fallen from its glory, and it's on the verge of being erased completely from communities across America where it once stood tall. How can a company that has been a pharmacy provider for more than 6 decades suddenly begin to fizzle out into oblivion? In this video, we'll look at RiteAid's beginnings, its business model, its rapid growth, the challenges it encountered, and the strategic mistakes that led to its fall. RiteAid Corporation began as a single store in the city of Scranton in northeast Pennsylvania in September 1962 by its founder Alexander Grass, a businessman and lawyer, and the store was named Thrifty Discount Center. The founder identified a market gap for competitively priced health and beauty stores. The initial focus was on these front-end products, but pharmacy services were quickly integrated into the business model. RiteAid's core business model revolved around a synergistic relationship between its in-store pharmacies and its front-end retail operations. The pharmacies were designed to drive foot traffic, which in turn would benefit the high-margin sales from the front end, offering over-the-counter medications, health and beauty products, personal care items, convenience goods, and seasonal merchandise. The company's expansion was swift. By 1968, just 6 years after its inception, the company officially rebranded as RiteAid Corporation and made its debut as a public entity on the American Stock Exchange, subsequently moving to the New York Stock Exchange in 1970. This rapid evolution from a single discount store to a publicly traded corporation with integrated pharmacy services within a mere 6 years reveals an aggressive growth orientation from the very beginning. This early ambition for rapid expansion and public market funding set a precedent for the company's operational and financial strategy for decades, an ambition that would ultimately prove to be a double-edged sword because of the high growth it created and the burdens that came with it. RiteAid's early growth was characterized by rapid expansion, achieving 267 locations across 10 states within a decade of its first store opening by 1972. By 1981, it had ascended to become the third largest retail drugstore chain in the United States, reaching a significant sales milestone of $1 billion by 1983. A pivotal moment in its expansion came in 1987 with the acquisition of Grey Drug, adding 420 stores across 11 states, which propelled RiteAid to become the nation's largest drugstore chain by store count, exceeding 2,000 locations. The acquisition spree continued into the mid-1990s with the buyout of the 1,000-store West Coast chain Thrifty Payless in 1996, along with other pharmacy store chains. This effectively doubled RiteAid's size to nearly 4,000 stores and established a coast-to-coast presence. A further substantial acquisition occurred in 2007 when RiteAid purchased the Brooks & Eckerd drugstore chains for approximately $3.4 billion, which increased its total store count to around 5,000 locations. While these acquisitions rapidly expanded RiteAid's store count and national footprint, the acquisitions were also linked to integration challenges, and the debt incurred contributed to ongoing financial pressures. This continued to the point where the costs associated with expansion began to overshadow the benefits, laying the groundwork for subsequent financial distress, which would eventually plague the company for decades. Beyond its foundational retail operations, RiteAid pursued various diversification efforts. In January 1999, it formed a partnership with General Nutrition Company's GNC, integrating GNC mini-stores within RiteAid pharmacies. In June 1999, a collaboration with drugstore.com allowed customers to place prescription orders online for same-day, in-store pickup, marking an early foray into digital services. A significant strategic move in 1999 was RiteAid's entry into the pharmacy benefits management (PBM) sector through the acquisition of PCS Health Systems. This was followed by the substantial $2 billion acquisition of EnvisionRx, later rebranded as Elixir in 2015. The stated aim of this acquisition was to significantly expand RiteAid's health and wellness offerings and gain entry into the specialty and mail-order pharmacy markets. While the strategic intention to diversify and integrate vertically, mirroring the strategies of larger competitors like CVS and Walgreens, was conceptually sound, the execution of these initiatives, particularly with the PBM segment, appears to have been flawed. The PBM venture, in particular, became a drain on resources rather than a driver of profitability, contrasting sharply with the successful vertical integration models adopted by CVS and Walgreens. In the late 1990s, cracks began to appear in the very foundation of the company's finances. RiteAid was overshadowed by a significant accounting scandal. The company had overstated its earnings by an astounding $1.6 billion over several years. This fraudulent activity led to the forced resignation of then-CEO Martin Grass, son of founder Alex Grass, and resulted in criminal convictions for him and other former senior executives. The immediate fallout from this scandal was severe. It profoundly shattered investor confidence, wiped out a substantial portion of shareholder value, and left RiteAid grappling with a heavy debt load and a multitude of legal challenges as it attempted to restate its financial records and rebuild trust. The company was forced into immediate debt restructuring and the divestiture of stores to avert outright insolvency. The accounting scandal was not merely a financial setback. It represented a profound blow to RiteAid's reputation and its capacity to attract both capital and skilled personnel. The event fundamentally compromised the company's internal controls and its credibility with vendors and the market generally. The scandal created a deep structural vulnerability that persisted for decades. It meant RiteAid was perpetually operating from a position of disadvantage, constrained by its past misdeeds and a tarnished public image. This inherent weakness rendered it less capable of withstanding subsequent market pressures and strategic challenges that will undermine future recovery attempts. The pharmacy market was changing rapidly while RiteAid's financial problems were brewing. RiteAid operated within an intensely competitive landscape, facing relentless pressure from industry giants like CVS Health and Walgreens Boots Alliance, as well as mass-market retailers such as Walmart and Target, all of whom operate significant pharmacy departments. RiteAid was caught in a profound strategic squeeze and had lost its market leadership position by number of storefronts. It also lacked the sheer scale and diversified healthcare ecosystem of its larger rivals, making it difficult to compete effectively on price with mass retailers or on integrated services with CVS and Walgreens. Its own attempts to mimic competitors' strategies, particularly its pharmacy benefit management efforts with Elixir, failed to yield the anticipated synergies and instead became a financial drain. Beyond strategic missteps, RiteAid was plagued by fundamental operational inefficiencies and critical supply chain vulnerabilities. The company carried the burden of numerous unprofitable stores and costly, non-terminable leases, which resulted in an estimated $80 million in annual dead rent, even after initial store closures. This drain on resources was compounded by severe liquidity constraints that prevented RiteAid from adequately replenishing its front-end inventory. The escalating opioid crisis and the ensuing litigation represented a major external shock that severely impacted RiteAid's financial health and public standing. By early 2023, RiteAid was facing over 1,600 opioid-related lawsuits. A significant blow came in March 2023 when the U.S. Department of Justice filed a civil complaint alleging that RiteAid had violated the Controlled Substances Act by filling unlawful opioid prescriptions from 2014 to 2019, despite clear red flags. In response to these allegations, RiteAid agreed to a settlement that included $7.5 million in civil fines and an unsubordinated general unsecured claim of $401.8 million. RiteAid's traditional business model, which relied on the symbiotic relationship between pharmacy foot traffic and high-margin front-end sales, proved increasingly vulnerable to shifts in consumer behavior. The company struggled to adapt as shoppers increasingly gravitated towards online shopping platforms and discount retailers for their everyday needs. This represented a structural shift in its market, primarily driven by changed customer behavior, particularly among low and fixed-income consumers, who increasingly opted to purchase household goods from more affordable retailers. On October 15, 2023, RiteAid filed for Chapter 11 bankruptcy protection, citing its inability to service nearly $4 billion in funded debt and mounting legal liabilities, particularly from opioid-related claims. The primary objectives of this restructuring were to deleverage its substantial debt, address the numerous opioid claims, and rationalize its extensive store footprint. The restructuring plan involved a debt-for-equity swap, a significant $2 billion reduction in funded debt, and the sale of its Elixir PBM business for $575 million and the closure of approximately 800 underperforming stores across the country. RiteAid emerged from Chapter 11 in September 2024, transitioning into a private company with its creditors taking ownership. Despite the initial optimism surrounding its emergence from Chapter 11 in September 2024, RiteAid quickly found itself facing persistent and intensified financial challenges. These financial constraints directly impacted its operations. The company continued to post significant net losses, a stark deviation from its projected financial performance. Less than a year after its first emergence, RiteAid filed for Chapter 11 protection again on May 5, 2025. This second filing was explicitly driven by a failure to secure new financing, persistent operational hurdles including inflation, rising rent and supply chain costs, coupled with shrinking margins, fierce competition, and ongoing legal liabilities from opioid lawsuits. In a stark shift from its previous restructuring attempt, RiteAid announced its intention to sell substantially all of its assets and confirmed it was in active discussions with multiple potential buyers. The 60-year journey of RiteAid Corporation, from its ambitious beginnings to its ultimate dissolution through multiple bankruptcy filings, offers profound lessons for businesses operating in highly competitive and regulated industries. RiteAid's downfall was not attributable to a single factor, but rather a confluence of systemic weaknesses and external pressures that compounded over decades. Let us know in the comments what lessons you got from this story, and please kindly subscribe to this channel to get more videos like this.